Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Alcana, and I also have Brentster Slava sitting along me, helping out. Also, Mighty Joe Young filling in very well for Brianna today. And I have Christian Magoon on the line, and he is the founder and CEO of a company that bears his name, Magoon Capital. Christian, how you doing this morning?
I'm doing well, Joe. How are you?
Doing good. Could you give us a little bit of your education and your background in the markets and how you ended up being a ETF guru?
Yeah, thanks, Joel. Well, I've been, in the marketplace since the mid '90s, really on the side of packaging investment products. So I've worked for firms like First Trust, Claymore Securities, now Guggenheim Investments. Magoon Capital is my firm that is a consulting firm to investment companies, and I also have a ETF sponsor called YieldShares. So involved in a lot of different types of projects, but they all kind of focus on packaging investment ideas for investors to access. Many of these ideas have been first of their kind. So, I had the privilege of launching everything from the first brick ETF in the United States to the first multi-asset ETF in the U.S., the first solar, the first timber, the first cybersecurity ETF. So I've been doing that for quite a while. And now I really have two facets in my business. I essentially help companies in terms of product development, launch new exchange-traded funds, and then I have my own sponsor, YieldShares. And in terms of education, I have a bachelor and master's degree from Wheaton College here in Wheaton, Illinois. And the funny thing is, Joel, Wheaton, Illinois is kind of a hotbed of ETF issuers. If you draw a little circle around maybe a 15-mile radius here, 3 of the top 10 ETF providers in the world are here in the Chicago suburbs, and that's Invesco PowerShares,
Right?
First Trust Portfolios, and then also Guggenheim Investments.
Okay, all that one area. Also, I noticed that you're one of the top 10 investment professionals to follow on Twitter, as determined by the Wall Street Journal. How did you come up? I mean, are you active in the Twitter sphere? What kind of information do you like to put out there? And I don't know, is it cumbersome, or is this just something you like to do to share your trading ideas?
Yeah, I think Twitter, I discovered Twitter several years ago, and it really has become a great source of information. There's some, whether it's organizations or individuals sharing a lot of ideas, and I find that it's very current and timely. I often learn quite a bit and get a lot of breaking news off of Twitter. So, my personality is a bit of a student slash teacher. Really like learning from a variety of different types of investors and organizations, research companies, and then I like kind of being able to share those ideas. So Twitter really gave me the chance to plug into all these types of sources, and then at the same time curate a little bit and share some of the ideas, research that I felt was very valuable. So I've been fairly active in the space and try to get content out quite a bit, and I was pleased to be included in that list of kind of top tweets for your money from Wall Street Journal. So it was an honor, and again, I kind of view my role on Twitter is to not only consume content, but to hopefully curate and create some of that content as well to kind of contribute to that community. So I'd encourage people to get on there if they aren't. My Twitter handle is just my name, at Christian Magoon, and start sharing content because it's a great place to learn and grow.
What do you think of the stock?
Yeah, it's an interesting company. I feel like they've got a ways to go to really try to monetize the service. I think the underlying business model in terms of being able to share information and follow people who I think matter is amazing. And I've found myself migrating more to Twitter for, again, breaking news and more kind of in-depth coverage of topics than any other kind of traditional, let's say, news site. So I think it has a killer app. I think their challenge is, probably like many people, is just trying to monetize that, because often it's simply just a platform to get to that next news story or that next blog, and is there enough Is there enough structure there for advertising revenue to kind of be generated? So to me, that's what they need to do, is figure out a way to do that. And to me, I think there's some subscription models that they could do, as well as maybe share some more robust content than some of the links that are available. Maybe do some more video and other types of more, I guess, robust content. So I think it's a stock to watch. Certainly, if you believe in social media, I do, and I think it's just more about execution on their point right now from a revenue generation standpoint.
We're on the line with Christian Magoon. He's the founder and CEO of Magoon Capital, joining us here on Benzinga's Pre-Market Prep, brought to you by MarketFi. Well, I don't know if this is like a difficult question or not, but can you just talk about the process of like putting together an ETF? I know you're working on this or have the cybersecurity ETF. Just walk us through the process, how you decide on what stocks to put in there, and just give us an idea of what works it takes to do that.
Sure thing. So, yeah, I've had the privilege of being a part of almost now 60 U.S. ETF launches, and many of these ideas are very kind of unique. A lot of times, first to market, and a lot of it really begins in the initial construction process of the basket. By far the majority of the ETFs I've been involved in are index-based. So really that goes down to index construction. So the ETF generally follows an index, and that index has to be investable. So one of the biggest kind of foundational needs for an index is to be able to have a universe of companies that not only has some material revenue drivers within that industry or within that theme, so they have to be as pure as possible, but also they have to have enough underlying not only market cap but also daily trading liquidity, because that ends up being kind of what dictates the liquidity of the ETF. You don't want an ETF that has very wide bid-ask spreads when it's trading. You want those bid-ask spreads to be tight for investors to be able to get in and get out. And ETF liquidity, unlike stock liquidity, really is based off what the ETF owns or the underlying securities. That's why you'll see, for example, a Vietnam ETF have wider spread generally, not trade as good as something that's maybe a U.S. large cap ETF. So a lot of it starts in the underlying index construction. The same would be true for active ETFs. You want to have liquid underlying constituents that you're trading in and out of as a portfolio manager. And when you don't have that, you have issues where funds can not trade as well, or potentially trade at valuations that don't always make a lot of sense. So we've seen times when, for example, some bond ETFs have traded at premiums to their underlying asset class or market segment, and that often is a function of the fact that there's not as much liquidity in the bonds as there is in the ETF. So the ETF starts to quote unquote disconnect from the underlying value of the securities. But in reality, it's actually probably a better price discovery vehicle, the ETF, because there's more liquidity and the market's able to embrace that more. So a lot of different issues, but I'd say liquidity, market cap, and really having an investable index is kind of the key to building an ETF that works well in the marketplace.
Okay, let's talk about your cybersecurity ETF. Do you have a symbol on that?
Yeah, so one of the great ingredients about an ETF is making sure you have a ticker that makes sense, and this ticker is HACK, H-A-C-K. We want something that's memorable. We've done a fair amount of different types of tickers, and this is one of the top ones in terms of, I think, people remembering. They may not remember that it's the Pure Funds ISE Cybersecurity ETF, but they definitely remember HACK, H-A-C-K.
Okay, and who are some of the big components in that one?
Yeah, so Joel, the ETF is an index-based ETF, and the index is a group of companies actively involved in cybersecurity solutions, basically in three areas: hardware, which is kind of the general equipment, servers, etc., software, authentication, etc., and then services. There's a fair amount of firms that do perform consulting services in cybersecurity. So The fund owns 26 companies across really geography, market cap, and industry. There's about five countries represented, U.S. being the largest weight in the portfolio, a little bit more than 80%, and a variety of kind of sub-industries within the industry exposure, everything from what you think of as traditional software companies to communication equipment companies, and internet service providers, even one categorized as aerospace and defense. And then when you look at the top holdings, actually all the holdings, you see very little overlap. Kind of the big surprise we've seen is that if you own, traditional broad-based technology ETF like the Nasdaq 100 QQQ or the Spider Technology ETF XLK, there's less than 5% portfolio weight overlap in hack with those funds. And that's because top holdings are fairly unknown companies. Vasco Data Security International, VDSI, is the top weighting in the fund. It's a firm that does a lot of work in the two-factor authentication area in terms of cybersecurity. It's less than $1 billion market cap. Imperva, IMPV, is the second largest holding. That company really focuses on firewall technology, a lot of individual device security, which is called endpoint security. So these are fairly specialized companies when you look kind of across the gamut. There's a few that people would recognize as well. Palo Alto Networks is kind of the poster child, PANW, for cybersecurity. And you get a couple of firms in there that you've probably heard before if you've worked in a corporate setting with Barracuda Networks or Symantec. So I think it's a fairly unique portfolio, and what it allows the investor to do is not have the risk of picking one or two cybersecurity winners, but instead owning the basket that's diversified across different types of businesses and geographies.
And you also have the highest yielding ETF out there, and the symbol is YYY for yield, yield, yield. And here you are. This thing just seems like it's kind of quiet. Talk about what is in that component. What's it yielding right now?
Yeah, we just talked about a growth idea. On the other gamut is the YieldShares High Income ETF, and that ticker is YYY. It's an ETF that's index-based that owns 30 different closed-end funds from managers like BlackRock, Nuveen, PIMCO, Allianz. It's an income play, so totally different. It's the highest yielding diversified ETF in the United States with a 30-day SEC yield of 8.4%. What does it own? It actually owns funds, closed-end funds, which are similar to mutual funds, except they trade on a stock exchange. And the one kind of feature that we're trying to take advantage is you can offer and buy these closed-end funds below their net asset value. So the average closed-end fund we're buying right now is trading at a little less than 3% below NAV. So for 97 cents roughly, we're able to buy $1 worth of fund assets from, again, these well-known managers. And when you look at the portfolio, 60% of the portfolio roughly is invested in stock funds, many of them utilizing covered call strategies. And then the other 40% roughly is invested in traditional bond funds, anywhere from senior loans to high yield bonds to even some investment grade bonds. When you wrap it all together, because we're being able to buy a little bit below NAV, and closed-end funds tend to be more income focused, the fund is able to produce a current 30-day SEC yield of 8.4%.
Wow.
Pays on a monthly basis. We paid 17 cents a month every month this year, and the fund will actually rebalance its portfolio at the end of the year. So for it, it's hard to capture a lot of material income right now, especially if you want to have some of that income come from equities and not just be kind of all bond oriented. I think this fits kind of in a hybrid bond allocation where you can have some equity exposure, some bond exposure, and then again have those actual asset classes managed by the likes of BlackRock, Nuveen, Allianz, PIMCO, etc. So YYY is the ticker on that, and it's another fund that kind of I'm involved with in the marketplace.
And wow, that thing got down to $21 in the Ebola lows there, but now it's bounced right back. So basically, Besides that, you're probably pretty safe on your principal value, right? I see that besides that has been trading in a very, very narrow range. So, I mean, unless you have another situation like that, it looks like your principal's pretty safe. And boy, 8.8%, I don't know. You're talking pretty good yield to me. Just for something like this, obviously it's predicated, on interest rates and what's going on. I mean, just we're going to have a roundtable early next year on what the Fed's policy going to be for 2015. But really, I guess the only thing that could really put the hurt to this ETF would be, a rise in interest rates. And some good job numbers out today, kind of going along with what the Fed said. Could you give us your short term and your long term outlook for interest rates?
Sure. So, Joel, you're exactly right. We're in a very low interest rate environment, and should rates rise, which the market expects rates to rise probably early to mid next year. I would say we do too. And when rates rise, income-oriented investments generally are impacted on the NAV standpoint. One of the statistics we think is important to keep an eye on whenever you're looking at kind of bond or fixed income investments is duration. And duration is simply kind of a measure of how an investment will be affected in terms of a rise in interest rates. And its duration is measured in years. And generally speaking, the higher amount of years or higher amount of duration a fund or an investment has, the more it's going to be impacted by a rise in interest rates. And we really believe that investors should look at lower duration investments because of where interest rates are, meaning because we think that interest rates are likely to rise next year, we think that investors should take a look at their portfolio and try to position their portfolio in securities that will receive less impact from a rise in rates. So a lot of short duration funds are out there and are popular now. Short duration is probably more like a year to 3 years. That's kind of a range that tends to be on the shorter end of the curve, if you will. The longer duration funds are more like 5 to 10 years. So that's something I think to really keep in mind given where we are. The one nice aspect of owning a product that has equity exposure and bond exposure is that the equities generally have a zero duration versus bonds with their relative duration. So, for example, in the YieldShares High Income ETF, YYY, we look at the effective duration of all the securities that are in the portfolio, all 30, and the effective duration is just a little over 2 years, 2.1 years. So we like the fact that the equity exposure kind of lowers our overall duration. We think that's attractive for investors. So, certainly duration is something to keep in mind next year because we do think interest rates are going to rise. The market has thought interest rates are going to rise quite a bit over the last 3 or 4 years, and frankly, there's been a lot of income and money given up in terms of people positioning to protect against that rate rise. But it now seems very likely based off Fed comments and kind of the progress of the economy in its longer-term recovery. So we think that's important going forward to just keep an eye on that duration and make sure that you're not overly exposed to kind of a negative effects of rising rates.
Okay, Christian Magoon, founder and CEO of Magoon Capital, giving us his outlook on the ETF market. Christian, thanks for joining us, and we hope to have you back on again soon.
Thanks, Joel. Make it a great weekend.
Okay.